Hello and welcome. We're pleased that you joined us for today's session, which is part of our Private Foundation webcast series, Comparing Public Charities, Private Foundations, and DAFs. Before we begin, I'm going to play our housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves, and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in your console. And now, I'd like to introduce today's presenters, Pam Alexanderson, Director, Steve Talbot and April Stith, both Senior Managers. We also have a special guest joining us today, Jonathan Blum, Partner with Holland & Knight. Their bios and contact information are located in your console if you would like more information. Now, I would like to turn the floor over to Steve to get the presentation started. Steve.
Thank you, Danielle. First, I'd like to go over some of the learning objectives for today's session. First, we'll like to understand the structure and rules to maintain tax exemption for public charities, private foundations, and donor-advised funds. And then the second objective would be to help you determine which structure may best fit with your philanthropic goals. We'll be offering for part of the session some slides with an overview of the different structures, and then we'll finish our session with a panel discussion and take questions from the audience. But first, we're going to start with our first polling question.
All right, everybody, here's our first poll. What kind of charitable vehicles do most of your clients currently use? Options provided: A, gifts direct to public charities; B, establishment of donor-advised funds; C, establishment of private foundations; D, establishment of charitable trust or other. The polling questions are located right on the slides we are presenting. If you can't see it, you may need to hit the F5 key to refresh your console. To respond, please click the button next to your answer you choose and make sure to hit the Submit button. All right, and we will forward to the results.
It looks like there's a broad range of interest on what the different types of charitable vehicles that are used. So our next slide, I'm going to turn it back over to April just to give a brief overview.
Thanks, Steve. So it was great to see such a nice wide variety of vehicles being used by your clients. While we are focusing on the first three during this presentation today, hopefully we can give you some additional information to better match intent with the different charitable vehicles on a going forward basis. First, we'll have a quick overview of the three types of charitable vehicles we'll be speaking about today. A public charity is an organization that is generally supported by the general public. Donors receive tax deductions in the year of the contribution. Public charities can hire staff to run the organization, and it is overseen by a board of directors. Public charities can make grants both to individuals and to other organizations. In comparison, a private foundation is an organization usually created by a single individual, a family, or business. Donors to a private foundation also receive tax deductions in the year of contributions. However, those have lower thresholds for deductibility. Private foundations can also hire staff and are overseen by a board of directors. However, the board for a foundation oftentimes includes members of the founding family or founding business, employees of the founding business, while the board for public charity are usually made up of unrelated members of the public, as well as interested donors. And finally, private foundations are more limited as they can make grants to individuals and public charities only. Our third charitable vehicle for today is the Donor Advised Fund. These are charitable investment accounts administered by a sponsoring organization that is usually organized as another public charity. Donors can receive a tax deduction in the year of the contribution, and there are a variety of assets that can be donated into the fund. While donations to public charities or grants from private foundations can be effectively controlled by the donor, in a donor advised fund, the donors can only recommend grants from the fund to qualified charities. However, the sponsoring organizations do have the ultimate approval power for distributions out of donor advised funds. They can only make distributions to qualified 501c3 public charities in good standing. So this will take us to our next polling question.
Thank you, April. All right, here we are at poll question number 2. Which kind of charitable vehicle are you most excited about hearing today? A, public charities, B, private foundations, C, donor advised funds, or D, all of the above? As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 poll questions. Again, please click the button next to the answer you choose and make sure to hit that Submit button. Wonderful. We're getting lots of responses, so I'm going to go ahead and forward on to the results.
Oh, that's excellent. D was the correct answer, everybody. I'm glad to see so much excitement for getting to learn about all 3 of these charitable vehicles. And so now we're going to get a bit into the more technical information portion of the presentation. So this is a basic representation of how a donor-advised fund works. The donor identifies cash or other appreciated assets that they want to use for setting up the donor-advised fund. The donor then works with the sponsoring organization to set up the fund. The donor would receive an income tax deduction and can possibly avoid capital gains tax by donating appreciated capital assets into the fund. DAF sponsoring organizations include Fidelity Charitable, Schwab Charitable, and the National Philanthropic Trust, which is actually organized as a public charity, or your local or regional community foundations. Oftentimes, the sponsoring organizations do charge an administration fee based upon the fair market value of the account. NPT charges up to 85 basis points, plus investment management fees are also charged usually by all funds. Fidelity Charitable is about 60 basis points. Schwab Charitable is also up to about 60 basis points. And then usually, at least annually, the donor advisor or the advisory board will provide the sponsoring organization a list of donations that they are recommending to be made out of the fund. The sponsoring organization will then vet those donation requests and will make the ultimate decision on if they will make the grant. While cash and publicly traded securities are almost always great assets to use to fund a donor advised fund, you may also be able to get more benefit from contributing other types of assets. The acceptance of these assets is at the discretion of the sponsoring organization, and therefore a donor should be having discussions with the charitable staff regarding what their acceptance policy is. Also, the donor needs to be aware that the assets used to fund a donor advised fund may be sold and the cash reinvested almost immediately. So if the donor does have an emotional connection to an asset, that is a consideration in using it to fund a donor advised fund. What you're seeing on your screen now is an example of the tax savings by bunching up 10 years of charitable donations into one transfer into a DAF. The donor receives the tax deduction in year one when they're at a higher tax rate. The DAF can then make annual $10,000 distributions to the public charities over the 10 years. The charity sees no difference in their overall cash flow. So as I mentioned before, the donor or advisory board members provide the sponsoring organizations recommended amounts and charities to make the distributions from the funds. Those sponsoring organizations do have the ultimate say as to whom and the amount is distributed out of the fund. And the organizations qualified to receive donor advised fund distributions must be public charities in good standing per the IRS's exempt organizations business master file. And a link to the extract file, which is very large, is included in your slides. And now I will hand this next part over to Steve to discuss public charities.
The next few slides, I'm going to be talking a little more about how an organization is determined to be a public charity or a private foundation. And I'll start off first with public charities. There are some institutions such as churches, universities, hospitals, and research organizations that are automatically classified as public charities. But for other organizations to become a public charity, they either have to show that they have broad public support, and that's demonstrated by passing a public support test in the current year or the previous year, or an organization could become a public charity by being a supporting organization to another entity. But to do that, they have to pass stringent organization and operational tests to be able to do so. So with the public support tests, organizations show that they have either received broad public support, either by receiving contributions or program service revenue, as I said, from a broad base of either donors, clients, or customers. The public support test is reported on Schedule A of the Form 990, and there are two public support tests in Schedule A. The first test is for organizations that generally receive most of their income from contribution revenue. To pass the support test, these organizations should show that their donations come from a broad base of donors, or could also be in the form of government grants or contributions from other donation-based public charities. The second public support test is for organizations that earn most of their revenue from program revenue. Here, the revenue should be shown as coming from a broad base of clients or customers instead of from a single payer or a couple of payers or contracts. To pass the public support test, either of the two public support tests, a public charity has to show that it receives at least a third of its revenue from the general public. The public support test is a 5-year test, so it takes the revenue that's been received over 5 years to do that calculation. Essentially, the calculation, the percentage is determined as public support over total support. For organizations that use the first type of support test, there are some exclusions from public support. If there are any donors that give more than 2% of total support over that 5-year period. And then for the second support test, public support is restricted. Donations from disqualified persons are excluded, and then payments from a contract that's over 1% of total support would also be excluded from the public support test. Organizations that use the first public support test, if they fall below that 33 1/3%, can pass the public support test using a 10% facts and circumstances test. And if an organization looks to uses a test and doesn't pass that, it could try to pass using the other test. But the test has to be met for 2 consecutive years. If it's not met for 2 consecutive years, then the organization becomes a private foundation. And then there is a question in our Q&A that says, are there any colleges or universities that may not be public charities? How would you determine if there's a problem? I think in general, and anybody else can chime in general, colleges and universities, if they're not public colleges and universities, would submit an application to be exempt, and in that application to be exempt would show that they are a university, and then would be automatically considered a public charity.
Steve, I might just add that there are actually a lot of private universities and colleges that would fall more under the private, well, not private foundation rules, but I think the question might be, is it a public charity versus a private school, or public school versus a private school? And so usually those colleges and universities that are state sponsored or public, and then obviously the ones, like maybe some of those Ivy League schools would be considered private colleges, but still public charities.
Right.
Yeah.
Thanks, Pam. The next group of public charities I wanted to talk about a little bit are supporting organizations. Supporting organizations aren't required to complete a support test, but they have to meet these following requirements. The supporting organization has to be organized and operated exclusively to benefit or perform the functions of or carry out the purposes of its beneficiary organization, or as it's also called, a supported organization. The supporting organization also has to be operated, supervised, controlled by, or in connection with this supported organization. and lastly, it can't be controlled directly or indirectly by a disqualified person. For the most part, supported organizations are generally public charities, but they could also be 501c4 organizations or C5 or C6 organizations, and a supported organization could also be some type of governmental entity. There are, and then just a little more with supporting organizations, they're classified as different types of supporting organizations. The first type is type 1 supporting organization, and that is when the supported organization essentially controls the supporting organization, generally by being allowed to appoint the members of the board. It's similar to a parent subsidiary type relationship. The second type is a type 2 supporting organization, where the supporting organization and the supported organization are controlled by the same group of people. And then there are type 3 supporting organizations. There's type 3 functionally integrated or non-functionally integrated. And there's different tests that have to be passed that to determine whether they're that type 3 supporting organization. And then next, I'll talk a little bit about private foundations. At the start, all 501c3 organizations are classified as private foundations unless they can show in their exemption application that they are a public charity. As April mentioned earlier, they generally have a single source of major funding. And then most private foundations are grant-making organizations. There are some that do conduct charitable programs, but the way they earn their support, they're not able to meet a public support test. Different from public charities is that all private foundations are subject to a 1.39% excise tax on their net investment income. And another difference is that private foundations are subject to more stringent restrictions than public charities. One of those restrictions is self-dealing. With limited exceptions, private foundations shouldn't conduct any financial transactions with insiders to the foundation. Insiders can be foundation managers, board members, significant donors, or family members or entities that are owned by any of these people. Some of the types of self-dealing include the sale, exchange, or leasing of property between a private foundation and a disqualified person, a loan between a private foundation or a disqualified person, the payment of compensation or expense reimbursement between a private foundation and a disqualified person, and the furnishing of goods or services or facilities between the two. But as I mentioned, there are exceptions for compensation. If the compensation is determined to be reasonable and are for services that are provided and services that are necessary for the charitable function of the private foundation, then it's not considered self-dealing. And there are other exceptions regarding loans that could be made or provision of services or goods. If self-dealing does occur, the foundation and the people who receive the benefit can be subject to excise taxes. And then a few more of the restrictions that private foundations face that public charities don't include. Private foundations have restrictions against having what's called excess business holdings. In general, a private foundation and its insiders can't own more than 20% of a business. Public charities also cannot make investments that could jeopardize its ability to carry out its exempt purpose. And there's several types of things called taxable expenditures that are also prohibited, and I'll talk about those next. So a taxable expenditure is any amount that's paid by a private foundation to do lobbying or to influence a public election or to carry out a voter registration drive, unless certain requirements are met with the voter registration drive. Private foundations can make grants to individuals, but they cannot make grants to individuals for travel or study or similar purposes unless they receive prior approval from the IRS to be able to have such a program. In making grants, private foundations in general have to make grants to public charities or exempt operating foundations. If they make a grant to another private foundation or to a non-exempt organization, they have to do expenditure responsibility, which is a process where they do work ahead of time to determine that the grant should be made and then do follow-up to make sure that the grant is being used for the purposes that were specified. And then another taxable expenditure would be to carry out any other purpose than a charitable type purpose. And with all of these restrictions, the foundation could face excise taxes if they do them. And then I'll talk briefly about the different types of private foundations. There are private non-operating foundations. These are generally grant-making organizations. They do have a minimum distribution requirement that they have to meet, and that requirement is roughly 5% of the foundation's non-charitable assets. Again, they face excise taxes if that distribution requirement isn't met. Another type of private foundation is called a private operating foundation. These are organizations that conduct some type of charitable activity instead of just making grants. They aren't subject to this minimum distribution requirement, but there are other tests that need to be passed in order to be an operating foundation. From a donor's perspective, there are some benefits for public charities over private foundations. As April mentioned earlier, donations to public charities and private non-operating foundations are limited to 50%, or now it's 60% of a donor's adjusted gross income for cash donations, or 30% for non-cash donations. But when donations are made to a grant-making private foundation, those are limited to 30% for cash donations, 20% for non-cash donations. There's also the question of donor anonymity. Public charities do not disclose donors' names and addresses on Schedule B. Private foundations are not allowed to do that. They have to disclose the donor information. And lastly, here's a chart. Since you're able to download the slides, this is a chart that gives some comparison between public charities, private foundations, and donor advised funds. And then I'm going to send it back to April just to do a brief recap.
Thanks, Steve. So I know that was a lot of very technical information that we threw at you. So just as a refresher, public charities, gifts to public charities is usually the one that has a very large, big bang for your buck. They're probably the easiest ones to do. But, you know, gifts to public charities are for those organizations that are supported by the general public instead of small groups. Private foundations, again, are ones that are usually set up by single individuals, a family, a business. Some things to think about is when you want to start a private foundation would be times where you want a lot of control over the assets. The donor wants a lot of control over the assets, and there's a lot of assets there's more than usually 5 million. Most brokers or investment advisors normally don't accept portfolios under 5 million for private foundations. You should be considering the amount that you're going to be investing, the required annual distributions, your operating expenses. Also, when you're working with a private foundation, you need to be mindful of when to wrap it up. Loss of interest in the philanthropy. There are family issues such as a divorce. Compliance issues start becoming too much. Upon wrap up, you are required to distribute all the assets to a tax exempt or governmental entity. And under current tax law, it's still okay to make a distribution to a donor advised fund. And then again, donor advised funds, again, another very flexible option for donors that maybe want a large charitable deduction in 1 year, but spread out that cash flow to charities into future years. So it all works with whatever your client is working with at that exact time. So we're going to move on to our third poll.
Great.
Danielle will help me with.
Our third polling question: what type of charitable vehicle do you think would be the best fit for your clients? A, gifts to public charities. B, donor advised funds. C, private foundations. Or D, other. Just a reminder that you do have the option to submit questions in the Q&A window. We have quite a bit of content to go over today and a panel discussion coming up, so please be sure to input your questions if you have them for our team. And if we are not able to respond during that discussion, we will be sure to follow up with you afterwards. And the majority has submitted their response, so I'm going to go ahead and push us to the results.
Great, thank you everyone. It's nice to see a good solid spread between the 3 different kinds of charitable vehicles. So we're going to move on and quickly chat about some philanthropy goals. So the 3 things that we want to keep in mind is that when you're dealing with your philanthropy goals is identify the goals and your charitable intent. Those goals can be both during life and at death. You want to identify the correct charitable vehicles to achieve that goal, whether that's a donation to a public charity, a donor advised fund, or a private foundation. Are you intending to have your children or your grandchildren or a future generation continue to be involved? Is this your passion and it will wrap up with your passing? Donors can make transfers to public charities, create donor advised funds, or start a private foundation. For example, what's the size of your gift you're thinking about? The answer to what the correct charitable vehicle might be would change between if you're trying to donate $500,000, $5 million, or $50 million. And the most important thing is that you need to be willing to change course if needed. Sometimes things change, and what the donor thought was going to be the correct path to take ends up being not the correct choice anymore 2 or 3 years later. By being willing to listen to your advisors and consider an adjustment to better align with the current situation, you can continue to fulfill those philanthropy goals. And so here's another quick grid of pros and cons for our donor advised funds, private foundations, public charities. Donor advised funds, they're very, they're easy to fairly easy to set up. They do give you an amount of anonymity. However, there's limited succession at death, limited investments that can be held. Private foundations, a lot of control, also a lot of public disclosure, and a lot of compliance work. And with public charities, again, sometimes this is the easiest for a donor. One and done, you have some limited anonymity available, but there's also costs of compliance sometimes, exposure if you're assisting a founder or if you're a related party to a public charity. There's also some additional rules, federal and state rules to balance. So I think with that, we will move on to our discussion about governance. Pam?
Okay, so this is the panel portion of our discussion. As I look at all the questions, there are a lot of questions about changes based on the one big beautiful bill that has been passed. So we will get to that hopefully sometime in the next 25 minutes, but wanted to start the panel discussion a little bit with governance, because there are definitely governance differences between the three types of charitable vehicles we're talking about today. So wanted to bring Jonathan into the conversation. And Jonathan, do you want to talk a little bit about the governance differences between these three?
Yeah, thanks, Pam. So between the three options, the donor advised fund, the private foundation, and the public charity, there are pretty significant governance differences. We can start with the one that is most able to be controlled, which is the private foundation. The IRS expects that substantial contributors to a private foundation will essentially control the governance structure of a private foundation. And that's the reason why there's so many rules that can limit some of the opportunities there for interactions. But essentially, the family members, for example, that create it can control it. Next, you move to a public charity, which is really for a more public benefit. And the IRS typically frowns on families controlling a public charity. They really prefer a much more diverse governance structure where a variety of community members get engaged on the governance of a public charity. And a donor advised fund, really the governance structure is the sponsoring organization that essentially controls the funds. But donors and advisors get to make recommendations. And so it's not the same control, but there's an opportunity to have input on the use of the funds, hence the name donor advised fund, where you get to make recommendations about how to allocate those funds. And ultimately, the sponsoring organization makes the ultimate decision about whether it goes to those public charities that you've selected.
Okay, thanks, Jonathan. Anything to add, Steve or April? Just want to, for sure, something you want to consider as you're looking at choosing one of these alternatives for philanthropic goals, or you're advising people on what to choose is, obviously, as Jonathan talked about, the governance is very different between the three. And so definitely something to consider. So Jonathan, what about asset control? Who controls the assets of these various types of entities?
Yeah, in all three circumstances, the board ultimately has control over the assets. So assuming a private foundation is controlled by the family, the board of the foundation, assuming it's set up as a nonprofit corporation, if it's set up as a trust, the trustees control. But essentially, it's, as I mentioned, the control of the assets is by the board that makes decisions about how to allocate those funds. In a donor advised fund, the donor is the advisor, or if they designate others as advisors, they don't actually have control over the assets. The sponsoring organization has title to the assets, has control, and even what's called a variance power that allows them to make changes to what the donor advisors recommend. And ultimately, it's because that donor advised fund structure allows the sponsoring organization to maintain control of those assets. And in the public charity, it's the board as well that has the control over what happens to those assets in furtherance of the public charity's mission.
Have you ever seen a situation in the donor advised fund realm where the donor advisor's wishes are not honored by the sponsoring organization?
Sure. So typically, I would say the vast majority of the time, the sponsoring organization will fulfill the donor's requests. There are circumstances where they would not comply with those requests, and it could be that the charity no longer has exempt status. So, part of the benefit of a sponsoring organization in a donor advised fund scenario is that they do the diligence for you. They will check on the status of the organization and make sure that it's a public charity eligible for receiving grants. So if they find that it's lost its exempt status or it no longer exists, it certainly wouldn't make that distribution. There may be other circumstances where the donor is receiving an improper benefit. That could be a reason why they may reject the request. It could also be that if the donor is, for example, an employee or a founder of the charity that they're making the request to, where the donor would receive a benefit, that would be problematic for under the donor advised fund rules. So those are two key reasons why a sponsoring organization might reject a request from a donor.
Okay, thanks, Jonathan. What about succession plans? So, certainly private foundations typically controlled by a family, started by a particular family member. Though, it's quite a different scenario for public charities and donor advised funds. But how do those succession plans differ? And, the factors that people need to consider for that.
Sure. With a private foundation, if it's set up by a family, they typically want that family to continue to control the foundation. And so there may be others that aren't family on the board, but they want to maintain the majority of the board or the control element of the board by family members and their descendants, particularly if the foundation is meant to survive in perpetuity. They want to make sure that to the extent there are any family members alive, that they have the ability to control the foundation. So they might set that into the governing documents, that there should always be a majority of the board that's made up of the lineal descendants of the original founder. There are other ways to ensure that those board members have that long-term status as for family members. Public charities typically don't do that. For the most part, they are self-perpetuating boards, which mean the current board elects the future board, and there's a broad diversity of representation on that board. And by diversity, I mean all sorts of things: skills, geographic origin, race, gender, etc. Just really to provide a lot of variation in terms of the governance. And then in a donor advised fund context, the advisor can select the successor advisor. So there can be a group of advisors, there can be succession, for example, parents that want their children to succeed in that role of advisor. And the sponsoring organization's board is usually made up of a broad, diverse range of people, as I mentioned, just like any other public charity would be.
Okay, thanks, Jonathan. I'm going to switch just a little bit, might even bring Steve and April into the discussion. Certainly there are administrative costs that can be quite different between these three. So just wanted to open it up to provide some input on the costs associated with the various vehicles.
Well, so for private foundations, there's significant administrative burden. You have an annual information return, a Form 990-PF that you're responsible for. You've got to do the back office accounting. You've got to do the administration. You may have salaries if you have employees that are helping to manage the foundation. And in a lot of ways, it's like running a small business. And so there are administrative costs associated with it. In terms of overhead, there are some self-dealing concerns that might be involved to the extent that they are sharing space with the founder or the board members. So in many ways, that can be free to the foundation to avoid some of the self-dealing risk. But in other ways, there's lots of administrative overhead and aspects because all of the administrative burden really is the foundation's burden. There's no one else who's going to handle it unless you outsource some of those administrative burdens. and that obviously has an expense as well. In contrast, a donor advised fund, there is a cost, but the administrative burden is handled by others. And so from that perspective, you have the sponsoring organization handling all the back office administration. They, to the extent someone makes a gift, they handle the donor acknowledgement letter. For the accounting, they handle all the accounting. For the investment costs, they handle all the investment costs. They handle all the back office, and including the 990 that would be for the sponsoring organization as a whole. So they complete all of that for you, but they do charge a fee for the assets under management. And the fee may vary depending upon whether it's a community foundation or a commercial provider. And those costs are relatively modest in comparison to managing the funds through a private foundation. I don't know if anyone else has any thoughts on
that. Okay. Well, thanks, Jonathan. Certainly want to consider that. One of the areas that I see a lot is, people want control. And so it seems like private foundation may be the best option. However, sometimes just the administrative overhead was not something that they usually considered when they're considering their philanthropic goals. So certainly something that you all want to consider as you're determining what might be the best vehicle. I'm going to switch gears just a little bit because I think we did have a couple of questions about maybe the different deduction limits for contributions to each type of entity. Steve or April? I know we might have had a slide on it, so I don't know if it makes sense to back up to that slide and go over that again.
I think for the contribution amounts, and I do believe that these got so contributions to a public charity or to an operating private foundation, which is the type of foundation that runs a charitable type program, those are limited to 60% of a donor's adjusted gross income for a cash contribution and 30% for a non-cash contribution. And that 60% had been a temporary change from 50% from several years ago, but the one beautiful bill has now made that permanent. For a private non-operating foundation or grant-making organization, the donations are limited to 30% of adjusted gross income for a cash donation and 20% for a non-cash contribution.
Okay. Thanks, Steve. Sorry to spring that on you, but I did know we had a few questions, so I appreciate you answering. Okay. So we don't have that much time left, and obviously everybody has some questions on the one big beautiful bill. So just wanted to open it up to the panelists to share your knowledge of the tax exempt provisions in the one big beautiful bill, and hopefully we're able to answer most of the questions that you all have submitted for that.
I note that someone mentioned that the House bill had a provision where private foundation excise tax would be a stair step depending upon the size of the foundation. It starts at 1.39 and goes up. Luckily for private foundations, that provision did not end up in the Senate bill, and so it did not get passed. So once the big beautiful bill was approved, other things that changed, there was the 60%, up to 60% of your AGI limit for cash donations to public charities. That was made permanent, so that's a good thing. But there were some other limits that were put in place for individual donors. There was a floor for those that itemize, that they have to exceed 0.5% of their adjusted gross income for those itemized gifts to be recognized. And then there was for those in the highest tax bracket, the 37% tax bracket, there was a limit of 35% for those contributions. And those are individual donors and their limits. I don't know if anybody else wants to.
One other item related to the charitable donations for taxpayers that don't itemize, the law made permanent a flat charitable donation that you could take up to $2,000 for married filing jointly taxpayers, or $1,000 for single taxpayers. That had been temporary for a couple of years and at lower rates. And then I think the other big item for tax exempt organizations from the bill was the increase on the excise tax for private colleges and universities, depending on a student adjusted endowment. It had been 1.39%, but that went up to 8%, I believe. Again, depending on the size of the endowment, so not affecting all colleges and private colleges and universities, but some. But that was one of the big items from the bill.
And that's an endowment value per student, right, Steve? So once you take the entire endowment, figure out how many students, once you exceed a certain threshold for endowment per student.
Right, that's correct. And
Right.
And one other thing the bill did was increase the threshold for the number of students that a college, to be enrolled at the college before they were subject to the tax. It had been 500 students and now it's up to 3,000. So that also took out a lot of, helped a lot of smaller colleges and universities.
Okay. And then I know as the bills were bouncing back and forth between the House and the Senate, there was some discussion about private foundation excise taxes. Do you want to comment on that, Steve or Jonathan?
Yeah, that was what I mentioned earlier that didn't make it into the Senate version.
Yeah.
There was up to 10% excise taxes for the largest foundations.
Okay. So private foundations can breathe a sigh of relief for now. Obviously, because those proposals were bouncing back and forth, I think our thought is that there is still some energy for going after private foundations a little bit by increasing the excise tax. So might need to stay tuned for anything that might come in the future with respect to that. One last question I did just want to ask the panels is, and as it relates to the One Big Beautiful Bill, are annual distribution requirements. So there's been some talk about increasing the distribution requirements for sure in the private foundation space over the last year or two. But can we talk just a little bit about what those annual distribution requirements are for private foundations and whether any of that applies to a public charity or donor advised fund?
So the minimum distribution requirements are for private foundations. A public charity doesn't have a minimum distribution requirement, nor does a donor advised fund, and only a grant-making private foundation has a distribution requirement, and it's generally, in rough terms, it's about 5% of their non-charitable use assets. So non-charitable use assets are typically the cash or the investments that the foundation has, the income through which it makes its grants. So while it uses that income from those investments to make the grants, the investments themselves are not considered a charitable use asset. But in the recent law that passed, there were no changes in increasing the minimum distribution requirement for a private foundation.
The one thing I do want to note is that we're talking about federal rules here. There are some states that have distribution requirements for public charities. So these are federal. So if you are in a state that does have their own set of rules in order to maintain your exempt status within the state, you might want to also look into that on a state-by-state basis.
Thank you, April. And then I think on the public charity status, one of the things that we've heard over the last couple of years is with respect to sponsoring organizations that have DAFs and making some sort of distribution requirement on a sponsoring organization or suffer an excise tax or some other sanction if those aren't met. The thought there was to try to get not have the donor advised funds really be a holding point for money. Those have grown substantially in value over the last 10 to 12 years as compared to where they were previously. And so we haven't really heard much, I think, on Capitol Hill with respect to advancing any laws for that, but just wanted to see if the panelists have any comments on that.
I think I was surprised that there weren't more issues related to payout requirements for donor advised funds and other kinds of issues in the bill. But it could be that it was, there were the rules of the Senate that required it to have to do with some sort of aspect of raising funds or cuts. So it doesn't mean it's out. There were certainly a lot of areas related to charities that were proposed in the past for tax reform bills, but even if it wasn't covered here, it could be back in a different form.
Yeah, certainly administration changes how the context of the laws get approved. So who knows? Donor advised funds were certainly a hot topic this time last year, and for regulation, and that has seemed to die down over the years. So, all right, we do want to get you to your last polling question. So, Danielle.
Thank you. Poll question number 4. What topic would you like more information on? I'll give you all a moment to review your responses here. And for those of you that would like a copy of today's slides, you can download them now from the console. We will also be sending them out via email tomorrow, along with a recording of the webcast. We'll leave this final poll up for just a few more moments while we get a few more responses. We've got just a couple more coming in, so I'll leave it open a few more moments. And the results.
Okay, thanks, Danielle. So certainly more on the governance topic, so we can definitely dive into that a little deeper going forward. And the charitable giving / planning when things go wrong, I'm sure that April can chime in the future with all kinds of horror stories with respect to that. Family dynamics, how to work with multiple generations, that comes up all the time for us, especially in practice, and then just anything else. So we appreciate you taking the time to respond to that poll. It helps us in the future. Real quick, Danielle, before you end, I know there are some other questions with respect to the One Big Beautiful Bill that don't have to do with tax exempt organizations. All of us on this webcast are tax exempt people. So we're probably not that qualified to comment on the questions that really are more individual or business provisions. So if we aren't able to respond to your question, that's why we can certainly see if we can find someone that can. But I'll let you wrap this up, Danielle.
Thank you, and thank you to all of our presenters for a great presentation today. To our audience, if you have any further questions or comments, please reach out to us as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to the presenters directly. Their contact information is in your console as well as in the slide deck, which you can download now from the handouts window. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. And finally, here's a link to the survey for today's presentation. Your feedback is always appreciated. Again, thank you for joining us, and take care, everyone.